We continue with our discussion on financial management under valuation of bonds. And one of the topics that typically covers fixed income securities and investing is the risks that are entailed in fixed income investing. Now, broadly speaking, there are multiple risks that manifest themselves when someone invests in a bond. But the primary risks that anyone faces are three in nature. We will list down those risks here. The first one is what happens to interest rates when you have invested in the bonds, because you remember that interest rates and bond prices are inversely proportional. So if rates go up, you could lose money on bonds. So what is the view of interest rate and how does the interest rate risk affect us is what is important while looking at bonds. The second is the fact that the bond carries a credit risk. What is a credit risk? The risk that someone does not pay, also known as, in other words, default risk. Right? So the scenario is that someone has borrowed money and there is a fair probability that this money being given does not come back. This is covered under credit risk. Finally, there is a risk of inflation. Uh, Inflation risk can be construed as if you invest 100 rupees in something and you get a return of 100 and of 5%, that gives you 105. The value of this 105 next year may be different from what the value of 105 today is. It's quite possible that what you are buying next year is expensive as compared to what you're buying today. So inflation has to be factored in the returns, and your actual return in real terms thus becomes lower than what the return is denoted by the bond, purely because usually inflation is in a positive territory and erodes the value of the currency that is available. Right? We'll look at each of these in more detail as we go along. And we will also try and find a measure of how do we actually capture and calculate some of these risks or quantify some of these risks, and can we find that and can we kind of use that while investing in bonds, right? So let's first take interest rate risk. We know that interest rates are kind of inversely proportional to prices of bonds. Why does that happen is, let's say if interest rate increases in the economy, then all existing bondholders will also require a higher interest rate, right? So the yield required by the investor increases. We have already seen that as yields increase, or yields wanted or yields required increase, price of a bond is a factor of the cash flow divided by the yield required. And if there are multiple cash flows, the yield is always in the denominator. So if the yield required increases, automatically the price of the existing bond will go down. We could also look at it this way. Let's say Government of India introduces a bond today that gives you 108 after 1 year, right? Now, you bought this bond for 100 rupees today and it'll give you 108 after 1 year. Now, 3 days down the line, Government of India introduces another bond that gives you 110 after 1 year. Now, what will happen? The entire demand will rush towards this second bond, which means there is no demand for the first bond, which means the prices of this bond will start falling in order to compensate for the lower demand and higher supply. Everyone wants to sell this bond and buy this one because this is offering a bigger amount, right? So effectively, if interest rates in the economy increase, the yield required by existing investors increases, thereby bond prices go down. The exact converse is also true, which could act as an opportunity sometime, is if interest rates go down, if interest rates decline, then bond prices will go up. Right? Take an example. Consider a 6% 20-year bond. This is going to give 6% every year. This is offering 1% premium to the market interest rate. Let's say interest rate in the market is 6%, is 5%. If you look at what's happening, is required yield by investors is 6%, let's say, and this bond is trading at $100, right? Now, what's happening is rates in the market are 5%, and this bond is offering 6%. This is a bond that, given the risk, gives 1% higher return, right? It's offering a 1% premium to the market interest rates. right? Let's take the example as, let's say this is the RBI rate and this is the rate by a company like Tata Motors. Obviously, RBI rates or Government of India rates will be lower than the company rates because company risk is higher, right? Now, at this point, the price of the bond could be 100. Now, if RBI increases the rates, obviously the company will also have to increase the rate offered, because otherwise people will start moving towards the RBI bond, and the extra 1% has to come in to compensate for the risk. Once this extra 1% comes in, automatically the price starts falling, it starts selling at a discount. If on the other hand, the RBI cuts rates, plus 1% premium for the bond gives you 5.5%, that takes the bond at a premium, right? So the bond starts selling at a premium immediately as interest rates decline in the market, right? Let's take another example, and let's say if we can measure this entire interest rate sensitivity or risk, there is a concept called duration, more appropriately something known as modified duration, that effectively gives a measure of price sensitivity to the changes in yield. Right now, if the yield changes by 1%, how much do you expect the price of a bond to change? That is effectively the quantification of the interest rate risk, right? Now, duration of a bond, as I said, more appropriately, we should construe duration as a term called modified duration. Exact definition of duration is a little bit complicated, and we leave that at this stage. Exact calculation of duration is also something that is a little bit complicated at this stage. So we will stick to our simpler definition of interest rate risk sensitivity, which is called modified duration. Modified duration of a bond gives us a measure of how much the bond price will move by 100 basis point. 100 basis point is equal to 1%. So 100 basis points is equal to 1%. When the RBI says they are changing rates by 25 basis points, they are effectively changing the rate by 0.25%, right? So 25 basis points is equal to that. So duration of a bond gives us a measure of how much the bond price will move with a 1% movement in yields. An approximate measure of this can simply be found by just changing the YTM of a bond slightly, right? We have a bond price equation, and we'll try and use this in an Excel file to understand how this works. And when we change the YTM slightly, obviously the price will change. How much difference does that change bring in the price, right? Let's look at an example and that clear things out. Assume that there is a bond with a coupon rate of 8% and a tenure of 5 years, annual pay bond, it pays only once a year, face value of rupees 100, and expected return or yield of 7.2%, right? Can we find the current price of this bond? The price should be NPV of the bond cash flows at 7.2%, right? The cash flows at 7.2%. That should be the price that we should be able to calculate, right? Let's look at the Excel file and try and see if we get the price, and then let's try and see if we can arrive at